Welcome back to yet another book review with Nyayartha, especially for students. The Low Risk Road for Stupendous Wealth. The moment I took this book, this was the first line I read, and I was as bewildered as you are right now. You and I, both of us know that high risk is high returns, low risk is low returns. Something we have been studying and reading for years together now. But this book, written by Mr. Saurabh Mukherjea, Mr. Rakshit Ranjan, and Mr. Pranav Unyal, defies this logic. They say that low risk can be high returns too. And the name of this book, as most of you would have already guessed, is Coffee Can Investing. And personally, I've been following Saurabh Mukherjea from years now. The time when he was the CEO of Avid Capital to now when he's the founder of Marcellus Investments. And if I say this whole book is just about coffee can investing, I wouldn't be doing justice for that too. So I'll be telling you 5 things I learned from this book, and the first and foremost is coffee can investing. And so what is coffee can investing? So coffee can investing is a word or is a term that is derived from an activity where people would take their money, keep it in a coffee can and forget that even existed. And it's not just something which is an American term, it's true for us too. We take our money, we put it under our pillows and we forget about it, so that one day when time comes, when there's an emergency, or even when we need some money to give the auto driver who is waiting for change, we want that money there. So that's how he talks, or he terms coffee can investing as. And in this case, he says invest that money in the equity market and leave it for at least 10 years for you to get handsome returns. So what does he mean by coffee can investing then now? So how do we invest in these type of stocks or in the equity market? Do we just invest in some stocks and forget about it? No. He gives 3 steps for investing in a company, and that too especially a good quality company. How? Step number 1. Check with companies which have more than 100 crore market capitalization. And he also says that there are around 1500 companies. And step 2, check its return on capital employed, that is the EBIT, that is earning before interest and tax, divided by capital employed, and see if it's around 15%, then it's probably healthy. And step 3, check its revenue growth, that is the compound annual growth rate of that company. Is it 10% or higher? Then this is a stock which you need to go invest in. And he says that invest in that company and forget for 10 years. And he says that like this, do it for around 7 to 8 companies. But now you may ask, is it same for all type of companies or all industries? No, it's different for the banks. He uses a different parameter to invest in financial institutions. There are 2 steps again. That is, the first step remains same, that is 100 crores market cap, but the other 2 steps are, he asks us to check return on equity. The last time we checked return on capital employed, but for banks and financial institutions he asks us to check return on equity. And he says check return on equity, see if it's at least it's about around 15%, then it's healthy. Then he says another step for the same banks or financial institutions, because banks have something called loan, and loan is an asset for them. For normal companies, loan is something which they need to pay, but for banks it's an asset for them, right? So he asks us to see if there's loan growth. If the loan growth is about 15%, then you are looking at a great company. So all these are just quantitative factors. So he doesn't ask us to go look at CAPM, that's capital asset pricing model, and he doesn't ask us to look at golden growth model or dividend growth model, nothing. He asks us just 4 parameters, that is 2 for a normal company and 2 for banks. Then is that all? That's all I invest and I sit? No, he also says good, it should be good and clean. He obviously tells this term to only small cap, mostly for small cap stocks, but at the overall, I think good and clean is a term which is very important for coffee can investment and portfolio too. Why? What is good and clean? Good is simply it's giving a shareholder a profitable investments and a profitable value. Clean is the corporate governance is good, the management is doing a good job and the management is clean. So this is G and C, and they've applied for a trademark as much as my research goes. So this is all about coffee can investing. I know it just summed up in a minute or so, but that's all it says. Invest in these type of companies, around 7 to 8 companies which are very healthy with the parameters mentioned above, and he says sit back and look at it, and he says that you get handsome returns, more returns than that of Sensex, that is the alpha, that is you get excess returns over that of Sensex, Nifty, the broad market index. And he also says that the drawdown, that is from the highest of this value of the stock and the lowest of its value of the stock, the difference is lesser than that of Sensex. So if Sensex is falling from 50,000 to 10,000, there is about a huge dip. Let's keep 80% dip. That's the example. I would take an example of 80% dip. But the value of the stock, even if that happens, the value of your portfolio will maximum reduce to 60%. That means he's saying that there is huge difference between the drop also. Even if there is some economic crisis, if you have invested in stocks like this, your portfolio will not drop as much as the index will drop. So this is all about coffee can investing. But as I mentioned earlier, I wouldn't be doing justice to this book if I just talk about coffee can investing, because this book is for every personal finance enthusiast, because he just doesn't talk about coffee can investing. He uses examples of Mr. Sangvi, Mr. Talwar and Mr. Kumar and gives practical examples for all of us. So what are those practical examples? So till now, whatever I told about coffee can investing is something which you must note down, but this is something which you can execute. So Mr. Kumar, Mr. Sangvi have different type of different backgrounds and all that, but you must read the book to understand the background and all that. But when I tell what is that which gives this book an edge over few other personal finance books I've read personally, is the way you talk with high net worth individuals or the way you advise high net worth individuals. So personally have experience working with high net worth individuals, that is HNIs, in the companies I've worked with. But this book gives a structured way of me handling it. Why? First, classification of goals and assets. If you are dealing with a person, you must know what are their goals are. So their goals could be ambitious, security, or stabilizing, or their assets could be personal or marketable or even aspirational. So it's like personal asset is gold which you're wearing, or marketable is gold ETF which you can sell it. And when it comes to aspirational, it could be a big bungalow or a villa. So that's aspirational. So he says the way he classifies it is absolutely amazing. And when he talks about the product knowledge, the second thing I love about it, the third thing actually, other than coffee can investing, is the product knowledge. He talks about equity, talks about debt, he talks about inequity, he talks about mutual funds, he talks about large cap, small cap, mid cap, multi cap, debt mutual funds, and then he talks about ETFs. And the third thing in personal finance is the way he explains the intricacies of it, the fees which you need to pay, the tax which you get, the pre-tax, post-tax. I mean, that's something which is absolutely valuable, invaluable if I can say, because I have not seen a place where everything is structured so well. And the last and the foremost thing is the exhibits. Believe me or not, there are 166 illustrations or exhibits in the whole book. That means 166 practical examples where he plots the whole index, and he says what is the difference between his portfolio and that portfolio, and for at least around 70 illustrations are just practical examples where you can execute it. So that is something which I love the most about this book. So at the end of this book, at the end of the day, this is a book which I would recommend every personal finance enthusiast or everyone who want to invest in the market, because as a person I invest in the market too, and that is something which this book something gave me a structure. And they have an Excel sheet too which is embedded in the book, where I can go and look at on Google. I just type that particular link and I get the Excel sheet to me too. So the whole book at the end of the day is great. And 3 ways you can still follow Saurabh Mukherjea, I know a few people are still waiting for that, is one, on his LinkedIn. Go follow him on LinkedIn. He posts a lot of articles and lots of posts. And second is his interviews and his his videos where he's interviewed in CNBC, Money Control. So he also interviews portfolio managers and fund managers, and that's something which I loved watching. I've binge watched it for 2-3 days continuously. So that's something I loved. And the third and the most important thing is Marcellus Investments YouTube channel. So that they explicitly give out tricks and methods how they are investing and their portfolio and everything. That's something which again I loved. So this is the 3 ways you can follow Saurabh Mukherjea. And at the end of the day, as I mentioned, I love this book. I recommend it to everyone who wish to read it.